Okay, let's go ahead and get started. Again, my name is Mike Walker. I'm the president of the Voluntary Benefit Shop, and today you are joining us for our most recent version of our bi-weekly webinar series. This is something that we do usually every 2 weeks, although in the fourth quarter, we tend to do it more like once a month just because everybody's so busy in the fourth quarter. But be ready. Once the new year kicks off, we'll have a whole new schedule of calls and topics for you all to enjoy. Again, if you're not familiar with us at the Voluntary Benefit Shop, basically we work with brokers and their clients every day to help bring them the best in voluntary benefits. My contact information you see on the screen here. So if you have a need for our services, just want some advice or want to run something past us, feel free to reach out. We're here to help. Again, today's program, we have the team from Allstate. And they're going to be talking to us a little bit about their life with long-term care program, some of the new options that have come along with that, also some of the things that are going on with some of the pending legislation that's out there and that type of thing. We have Katie, Jen, and Eric from Allstate all to help us today. And so with that said, Katie, I guess I'm turning it over to you for you to run with it.
Yes, thank you very much. Hi, everyone. My name is Katie O'Rourke. I am the Vice President of National Accounts for the Northeast. Look forward to speaking with you today. Here today to talk about life with our long-term care rider and how that might be a great solution for employees as we work through these new legislative challenges emerging in certain states and also just in general, because it is a really wonderful product for employees and something that's being asked for more and more. So the first thing we're going to touch on is Washington Cares. Washington was the first state to implement a long-term care mandate. Washington Cares required employees to have some type of long-term care coverage in place by 11/1 of 2021. If they did not have long-term care in place, they were going to be, or they were subject to a wage tax to fund a long-term care program. That long-term care program paid a benefit of $36,500 over your lifetime, basically for 1 year. It was 1 year of long-term care coverage. And that program really spurred a lot of interest in both Washington and really in the market in long-term care coverage. The reason why this really was applicable to Allstate benefits and to the voluntary benefit space is because life with a long-term care rider allowed employees to opt out of this program while also providing them with a more flexible vehicle to meet their long-term care needs. So just to give you a little bit more information about the Washington Cares Fund, it is the first taxpayer-funded long-term care program. And like I said, it's being looked at by a lot of different states who are looking to mimic this or expand on this as they are looking to meet the growing challenges around long-term care. It is funded by a mandatory payroll tax of 0.58%, and it's really been designed to help alleviate pressure on the Medicaid system. The plan should be starting funding on January 1st. Basically, that's when the payroll assessment will start, and employees needed to have coverage as of 11/1. And again, you had to have coverage of some type, and that life with long-term care plan qualified as an exception. So the question is, who would be interested in opting out of this program? Who would be a good potential target for a voluntary life with long-term care rider in these situations? So a lot of people in Washington chose to opt out, and we found that those people were typically higher income employees who may have spent more on the tax than they would ever receive on the benefit. There were also employees who were newer to the workforce, who were maybe more mobile, people who may not be considering retiring in Washington state, because you really were only eligible to receive this benefit if you did retire in Washington state. There are also employees who were retiring before 2025 because they would not have been eligible for funds. Really, at the end of the day, the key thing here is that this plan provided very little flexibility for employees because it had one benefit, and it really was not something you could take with you. Whereas life with the long-term care rider provides a lot of flexibility to build your benefit, tailor it, and obviously it's something you can keep with you if you move and use long into the future.
Hey, Katie, can I add something to that?
Of course.
So again, like I think like what we found, and we worked on a lot of cases in Washington State, last year when they were, implementing this, this tax, this process, et cetera. And what we found is that the vast majority of people, once educated on how the tax worked and what their options were, did choose to opt out. And the big reason was like, regardless of income, regardless of the state where they were going to end up, certainly those things came into play. But regardless of those things, the main reason why people wished to opt out was because it allowed them to control their own dollars, right? And so versus, when we pay into a tax, we don't necessarily have the ability to control those dollars. But if I'm having the money come out of my pay to fund a life with long-term care plan, like I'm controlling those dollars. I can choose the amount I want. I can accumulate cash value because it's a whole life plan. Um, I can take it with me when I leave states, et cetera. So it's really about control. And once people understood that, the vast majority of people, wanted to opt out. So I just wanted to add that. Thank you.
Absolutely. Thank you very much. And that's a really great point. The other thing I just would add to that is the nice thing about the Life with Long-Term Care rider is it's also something where you can utilize it in two different ways. So long-term care, obviously, you need to be in a long-term care facility to utilize it. And the statistics show that a lot of people will, or you need to require long-term care. It doesn't have to be in a facility. A Life with Long-Term Care plan, you can utilize it in two different ways. So that was another thing that was valuable to employees. So just to kind of talk a little bit about how this actually impacted Allstate and how we were able to capitalize on this opportunity. We actually were able to write 70,000 life with long-term care policies in Washington in 2021. And I will tell you, the vast majority of those came in really in the third quarter, with a lot of them coming in October. So this was a really significant opportunity both for Allstate Benefits and for our broker partners. And we expect, as more of these state mandated plans are rolled out across the country, that this opportunity is only going to grow. So we think that this is a really significant opportunity, not just as these mandates occur, but also prior to these mandates happening, because it has really raised a lot of awareness. We're talking to a lot of groups right now who are interested in putting plans in place because they know that this is coming either in their state or in states where they have a significant portion of their workforce. So I just want to mention that not only is this significant because of the fact that the mandates are happening, but it is significant because of the awareness that it is raising. So I won't go too much into this because I think it is very Washington specific, but I just want to mention that this is something that really has helped to drive a lot of business and a lot of awareness in the market. So where are we expecting this legislation to emerge? Obviously, right now, things are very up in the air. We just had a major election that affected the entire country. So a lot of this could change. But the places that have introduced legislation or talked about introducing legislation are in blue on the map. I can tell you the areas where we're seeing the most action right now are New York, Pennsylvania, California. They're the ones, at least, where I've heard the most noise. Pennsylvania's plan seems to be very similar to Washington, but obviously everything could change because everything's going to have to be reintroduced at this point. As mentioned, though, I think the big thing here is that a lot of companies are looking to get out in front of this. One of the major lessons learned from Washington is that it may make sense to provide less of an opt-out runway if states do move forward with this. That runway caused a lot of uncertainty, and it also caused a lot of people to opt out. So if states do move forward, we are expecting that window to be significantly reduced or potentially non-existent. So a lot of companies are looking to put coverage in place now so that they are ready if this legislation does pass and their employees have access to something prior to it becoming law. So just so you know, states in blue are states where there has been conversation or legislation has been proposed.
And Katie, you probably hear the same thing, but we try to stay pretty close to this because it's a big part of our business. But New York could very likely be next year when it passes, to be effective January 1st of 2024. And we've also heard some noise that In New York, even if it's effective January 1st of 2024, the tax that people would have to have coverage in place by July 1st of 2023 in order to be able to opt out of the tax. Now, again, that could change because, again, elections were just held, bills are going to have to get reintroduced, et cetera. And then California is very likely looking like it could be the next one that would be effective potentially January 1st of 2025. They have a commission that meets again, I think, in November and December to try to finalize what they're going to do in California. But I know you said those are two of the states where you're kind of seeing the most action. But that's just kind of a general update on some of the things that we hear, regarding, those states. But again, I think like what you said is very true, that this is really driving awareness and conversation. So even organizations that have employees, even organizations in many of these other states, it's a worthwhile benefit, but also like it's a cascading scenario. Washington State did it. Many other states are going to do it. And the reason is to try to take pressure off their Medicaid systems is really the reason. We're one of the driving forces behind it because, the long-term care costs really drive a lot of the costs that are associated with with the Medicaid program. So that's a big part of it. But anyway, Katie, I'll turn it back over to you.
Thank you very much. And that's exactly right. So we've got two ways you can solve for this potential challenge. One of the options is whole life. One of the options is universal life. In Washington State, both of these met the requirements for the mandate, and both of these can be great long-term care vehicles. I know just to be very high level, really the difference between the two, whole life is designed to be guaranteed. Universal life is designed to be flexible. Universal life tends to be a little bit less expensive. You can choose how you fund it. Whole life is designed to be a little bit more expensive, but it's something that doesn't need to be managed. You know exactly what it's going to cost. So you can kind of pick and choose which one makes more sense for you and your employee population. So just to kind of emphasize that one more time, the keys with the universal life versus the whole life. Universal life, it's illustrated. It's something you have to manage a little bit, but you can choose to increase and decrease your cash value, or excuse me, your premiums, etc. Universal life, set it and forget it. So both of these plans include can include long-term care riders. What you have here is kind of our standard long-term care rider. So 4% of the long-term care paid for up to 25 months. We did just file the ability to actually pay 6%, and that's available in a lot of states, not all states yet, but we're filing more, or it's becoming available in more and more states. So we're really excited about that. It would pay 6%, it would pay for 17 months. So it does decrease that a little bit, but it allows you to collect more of that money up front, which can be a really nice thing, especially in a high cost state like in the Northeast. We also have extension, which would extends the amount of long-term care you can receive. So instead of receiving it for 25 months, you'd receive it for 50. And restoration, which would basically allow you to receive your life insurance benefit alongside your long-term care benefit. Another thing we just rolled out is the ability to offer extension and restoration together. That's only available on the whole life. So that's something that we're really excited to offer and just really provides more value for employees. Just so you know, extension and restoration are both pretty affordable riders. I always recommend, if they're available in your state, that you include them because they really don't cost very much and they add a lot of value. We also have a chronic illness rider available. That is typically only available in states where where the long-term care rider is not approved. So it's available. It's something we can offer. One thing I want to mention, because I think it's really important when you're talking about these state mandates, is our product is sitused. So if you have the opportunity to offer it and situs it in a state, and you have multi-employee locations, which in the Northeast is a common thing, we can situs this and you offer the same product to all employees, which makes it much easier to enroll and much more tech friendly. So just to talk a little bit about how the long-term care works, this product works very similar, the long-term care rider works. This product works very similarly to your standard long-term care. So you trigger it with the loss of 2 ADLs. You have to be disabled and certified as you have to have a loss of 2 ADLs and be certified as chronically ill for 90 days. That's your elimination period. And then you actually can receive the benefit whether you are at home or in a facility. And it's an indemnity-based benefit, which means we will pay the full benefit amount regardless of your out-of-pocket costs, which I think is really important. You don't want to have to be collecting receipts and submitting that type of stuff if you're dealing with a long-term care scenario.
Hey, Katie, can I ask a question?
Of course.
So the 6%, right? Like, I mean, I like it. I think it's a good differentiator for Allstate because, we obviously deal with other carriers and usually that amount is 4%. I know you guys have 4 and you have 6 both as options, but kind of what was the purpose for offering the 6% option? Like, was that based upon feedback that you got from the market? Was there, some math, just like from a cost perspective, math involved that said like, hey, 6% is the right number? Can you share a little bit on the insight on like where that 6% comes from?
Absolutely. The goal was to try to get more upfront money to employees earlier on. So really what it boils down to is we recognize that the cost of long-term care is going up and going up very quickly, especially facility cost. So our goal was to try to provide additional funding to employees as early as possible. So that was really what we worked with our actuarial team, and I was actually on the committee that worked with our actuarial team to try to find a way to accelerate that benefit as much as we could. And 6% is where we landed. So, candidly, I don't know how much they spent looking at the market trends and kind of where the costs are, but I can tell you that from where I spend my time, it was just a recognition of the fact that, and this was even before inflation started to really kind of go wild, that the costs of long-term care have just accelerated so much that we needed to figure out a way to allow employees to access more of that benefit earlier on in the process. So, and most employees are seeing, or most people in a facility are in a facility for, I think the 2 years is about the cap. So, it felt right to kind of back that down to about that 17-month period of time. It's slightly under 2 years, but allowing employees to access that money a little bit earlier just kind of was where we landed in terms of making sure that that made sense. And then obviously if you've got that extension built in, you're well protected.
Yeah, if you have the extension, you actually have almost 3 years still with the extension. Now, so the 6% number I think makes sense. Like if you look at the average cost for in-facility care, it's like right around $100,000. So that's about, $8,400 a month, $8,300 a month, something of that nature. So if somebody does have if they do have a, $200,000 plan, that's $12,000 a month. If they have $150,000 plan, that's $9,000 to $10,000 a month in that area. So I get the math. I mean, and I think that makes sense. I was just kind of curious about from a product structure standpoint, what you thought about it. But I do like the 6%. And like you said, with the extension, it can still be almost a 3-year benefit. So that's nice.
Exactly. And like I said, the extension is really inexpensive. I always recommend employee, again, if it's certified or if we have it, that we add it. I think it costs, depending on your age, somewhere between 2 and 5%. So you're not talking about a significant load to the rates there. And it does provide a lot of value to employees.
Oh, yeah. It should always be on there. You're right. When available, it should always be on there. Good point.
And just to mention, I know we've had some challenges in the past about not having it in some states. We have filed in most of the states where we have not had it in the past. So within the next probably 6 months or so, you're going to see a huge increase in places where we can offer it, which is a great thing.
Good. Thank you.
Sure. So Mike, I know you wanted to talk through some of these case studies, but I think one of the things that I just want to mention before I hand it back to you is just to kind of drive home the point. This is a product that people are looking for, and it's a product that people are buying. So I think that's really important to emphasize, not just in Washington State, but even this year with no mandates in place, we are really seeing people look for this, and we are really seeing a huge increase in sales in this particular benefit.
Yeah, for sure. So everyone, I'll just share a couple of case studies with you. And both of these case studies are from our experience in Washington State, and they were both Allstate cases as well. So and they're from a variety of different environments. So this particular one, blue collar trucking company in Washington State, they had drivers throughout the country, but based out of Washington State. So they were looking for an opportunity that would allow their employees to become exempt from the tax if they chose to. So through Allstate, we were able to put together, a great offer for them. We had $100,000 in guaranteed issue. You can imagine how important the guaranteed issue was to that population. We didn't have to worry about, weight and medications and that type of thing. People could get $100,000. And we put together a very extensive education campaign for them that also allowed them to have access to our benefit education call center throughout the day, evenings and weekends to accommodate all their employees. And actually, out of their employee group, we had about 104 that enrolled out of that employee group. So really good enrollment. I think it was a company, I think there was about maybe 250 total employees, something of that nature, and about 104 of them enrolled. And that drove about $171,000 worth of premium. So you can see it's about, about 1,400 in average premium per enrollee. So it's a product that people buy and they spend money on and they keep as well. So we've had very little drop off from that group. So that's the first one. Second one, next slide, please. This was white collar, large technology company, kind of cybersecurity type of company, based in New York, actually, but with a large contingent of employees in Washington State. And there again, 100,000 in guaranteed issue, same type of employee communication campaign. And this particular one, employees could either self-enroll by going to a platform, or they could connect with our benefit education call center. They could do it either way. They had about 600 employees that were benefit eligible, about 151 of those enrolled. The total annual premium in that case was about $212,000. So again, nice enrollment, nice level of participation. That particular group has another 2,000 employees that are part of other divisions of the company in other states that we're actually going to be doing as well. We're just kind of in the process of trying to get that set up at this point in time. So still great opportunity there for even more business, but good case. Next.
Sorry.
I'll turn it back over to you. All good.
Yep. Thanks, Mike. Sorry. I muted myself just so I didn't have background noise and then started talking with the microphone off. So thank you so much. And just to emphasize what Mike said about these enrollments being sticky, we have actually seen less drop off in the Washington State enrollments than we had expected. And it's actually the persistency is actually better in Washington than it is across our block of business for permanent life. So that was definitely a concern we had initially. And very, very luckily, that concern has proven to be unfounded. So I'm really excited about that. It's definitely proving that people want this benefit and are maintaining it, which is a wonderful thing. So just very quickly, we want to talk through a couple of the reasons why we think Allstate really provides a couple benefits that are especially valuable, and a couple places where we think these benefits are maybe a little bit more advantageous to employees than some of our competitors. So we're going to talk through the whole life and the universal life very quickly, and this just talks through the life, and then the next slide talks a little bit through the long-term care. So just a couple things to mention. The whole life insurance is really designed to be very stable. It's guaranteed through age 121 with benefits paid up at age 95. We have the ability to offer age-banded rates, which makes it very flexible, and we can build it on third-party platforms. That I think is a huge differentiator for us. It's really difficult to build a lot of these plans on third-party platforms. We've had success building our whole life on many, if not most. So I want to emphasize that because I think that for us is a huge differentiator. Our universal life is not as platform friendly, and that is kind of by design. Universal life, as mentioned, is a little bit more of a complicated product that needs to be managed. We do really believe that that's a product that should be educated, where you need a little bit more education up front. So it's a little bit less tech friendly, and something that we would recommend maybe using, you need to have a conversation when enrolling this particular plan. But a couple things that are really important about this benefit: there's no benefit reduction. As mentioned, premiums are flexible, and it endows at age 95. So some of the reasons why that's particularly important: a lot of our competitors do have age reductions in their plans, especially some of the carriers that offer a term product, and one of the carriers that offers a universal life product. And then when it comes to the long-term care, as mentioned, 4% is our standard. We do now have the ability to offer 6%. Our restoration of death benefit actually is 100%. Whereas some of our competitors offer a more limited restoration. As mentioned, we do have the ability to offer extension and restoration now, which in the past we did not. And then one of the other things that I like to mention is we provide a very loose a very generous home visit or home care policy. So we'll pay 50% of the benefit for one home visit per month if you get one visit by a licensed home care professional per month, and we'll pay the full 100% for 2 visits. Some of our competition will prorate that, so you're going to receive less of the benefit, which I think is, a little bit of a takeaway. And then the other thing I want to mention is you do not have to be permanently disabled to receive this long-term care benefit. Some of our competition requires that, which can really reduce the amount of benefit you can receive. You can see situations where someone could require long-term care for a limited period of time. And we want to make sure that we are recognizing that, and those employees can collect the benefit if they need to. So that is it for me. Thank you very much. Just want to check to see if there are any questions. We very much appreciate your time, and thank you for taking some time out of your fourth quarter.
Chelsea, can we see if we have any questions in the chat that we didn't answer?
There are none that Katie did not answer. There was just the one from Jason, which Katie answered.
Hey, okay, yeah, Katie did answer. That's actually a fair question, though. People were asked. Jason asked if you add your spouse to your plan, or can they also be exempt from the tax? They can, as long as it meets the minimum criteria for being exempt, essentially, in that state. So, yeah. So it depends on how each state's legislation is filed. Does anybody have any other questions? We'll pause for a few minutes just to see if anybody has any other questions that they want to enter into the chat. Anyone? Okay. Again, I want to thank you all for your attendance today. I know everybody's super busy this time of the year. Pay attention because we will have more bi-weekly webinars kicking off after the beginning of the year. And if you want to prepare for this in those states that either have pending legislation or you just want to get proactive about introducing this to your clients, we at the VB Shop have a really, really great program that helps you be proactive about introducing this to your clients. We have a client webinar series that you can offer to your clients. It'll be just for your clients, not other brokers' clients, but just for your clients. And we can help use that to help educate your clients about this type of product and that type of thing. So if you are interested in that, feel free to reach out to us and we can talk about how we can partner with you to help you introduce this type of product to your client. So with that said, I appreciate your time today. Any other questions?
Mike, Jason did ask how many states locally is the product offered, Maryland, Virginia, DC, and if there's any limitations on the riders that are offered in any of the states.
It's a great question, and I actually pulled that listing up because I figured we might get that question. So if you don't mind, I'll pull that up real quick and just stop sharing my screen just so we don't have too much craziness while I do it. Okay, so local states where we offer the product. So we really do have it in most of the states locally. The one that I know is a big challenge for us is Massachusetts. So in that state, we just have whole life. We don't offer the universal life. And then New York. New York is a challenge for everybody. So just an FYI, in New York State, we don't have any product in New York. I don't know how many people do business in Vermont, but that's also a challenge. So I would say if you avoid those 3 states, and in Massachusetts, again, you're good. You just can't offer the universal life. You are pretty much good to go. But if you do have specific questions about specific states, feel free to reach out to the team. We're happy to get you more information there.
Any other questions?
That was it on our end.
Okay, everyone, really appreciate your time today. Again, feel free to reach out to us at the VB Shop if you want to get proactive about introducing this type of product to your clients. It's a very worthwhile product, and we appreciate your time today. Thank you very much.